Before we begin, a quick disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only and should not be considered financial or legal advice. The strategies discussed are based on my own research and experience. You should always consult with a qualified professional to discuss your individual situation before making any insurance decisions. Let me tell you about Mark. Mark got his car insurance renewal notice in the mail. His premium went up by 18%. He hadn't had a single ticket, no accidents, not even a parking violation. He'd been with the same company for a decade, the one with the funny commercials. He called his agent, who gave him some rehearsed lines about inflation, the rising cost of repairs, and new risk models in his area. The agent assured him he was still getting a great deal, a special rate for being such a loyal customer. And Mark, like millions of Americans, believed him. He sighed, paid the bill, and moved on. What Mark didn't know was that his loyalty was costing him exactly $912 a year. A competitor, one he'd never even heard of, was willing to give him the exact same coverage, with even better customer service ratings, for nearly $1,000 less. This isn't a rare story. This is the norm. The average American driver overpays for car insurance by over $700 a year. For many, it's well over $1,000. That's a vacation. That's a new computer. That's your emergency fund. And you are giving it away year after year, as a thank you gift to a company that sees you as nothing more than a number on a spreadsheet. Today that ends. This isn't just another video with a few quick tips. This is a masterclass. This is a step-by-step playbook on how to shop for car insurance like a pro in 2026. Over the next 10 parts, I am going to pull back the curtain on the entire insurance industry. I will arm you with the knowledge, the scripts, and the strategies to turn their own system against them. You will learn how they price their policies, the psychological tricks they use to keep you compliant, and how to spot the traps hidden in the fine print. We're going to decode every piece of jargon from liability to comprehensive. We'll expose the myth of full coverage, and I'll give you a list of every possible discount, including the ones they don't advertise, and exactly how to ask for them. By the end of this series, you won't just be a smarter shopper. You will be in complete control. You will never ever overpay for car insurance again. So let's start with the single biggest, most expensive mistake you are probably making right now, being a loyal customer. In almost every other industry, loyalty is rewarded. Your favorite coffee shop gives you a free drink after 10 purchases. Airlines give you upgrades. But in the insurance world, loyalty is a liability. They punish it. It has a name. It's a practice called price optimization, or what industry insiders sometimes call the loyalty tax. Here's how it works. When you first sign up with a new insurance company, they often give you a very competitive rate and introductory price to get your business. They might even lose a little money on you that first year. But they're playing the long game. They know that human beings are creatures of habit. We hate change. We hate paperwork. And shopping for insurance feels complicated and overwhelming. So what do? After the first year, they might raise your rate by a tiny amount, maybe 4%. You might not even notice it, or if you do, you'll chalk it up to inflation. The next year, maybe it's 5%. The year after, 6%. Each increase is small enough that it doesn't trigger your "I need to shop around" alarm bell. It's like boiling a frog. The water heats up so slowly, the frog doesn't realize it's in danger until it's too late. The insurance companies have mountains of data on this. They have algorithms that can predict, with terrifying accuracy, the exact percentage they can raise your premium before you're likely to start looking elsewhere. They know your breaking point. They know that customers who don't file claims and pay their bills on time are the least likely to shop around. So, who gets the biggest price hikes? Their best, most loyal, lowest risk customers. You are being penalized for being the exact type of customer they claim to want. It's a brilliant business model for them, and a financial disaster for you. Their entire system is built on this inertia. They have spent billions of dollars on advertising to build a sense of trust and familiarity. They want you to feel like you're in good hands, or that you have a good neighbor on your side. They assign you a friendly agent who remembers your birthday, creating a personal relationship that makes it feel awkward to leave. They push you to bundle your auto and home insurance, not just because it offers a discount, but because it tangles your financial life together, making the process of switching twice as complicated and twice as intimidating. Think about it. The bundle and save discount might save you 15%, but what if another company could offer you both policies separately for 30% less? The bundle is a cage, not a reward. It's all a carefully constructed psychological game designed to do one thing: stop you from doing the one thing that gives you all the power: shopping your policy. So, the first thing we need to do is change our mindset. From this moment forward, you are no longer a passive customer. You are a free agent. You are the CEO of You Incorporated, and your car insurance is just another business expense you need to minimize. You owe zero loyalty to any of these companies. They are not your friend. They are not your neighbor. They are vendors providing a commodity service, and you are going to award your business to the vendor who provides the best possible service for the absolute lowest price. Period. I want you to reframe the entire process. Shopping for insurance isn't a chore. It's a high-paying job. If you spend 1 hour of your time researching and making a few phone calls, and it saves you $800, you have just paid yourself $800 an hour tax-free. Show me another job that pays that well. When your renewal comes up, you shouldn't feel dread. You should feel excitement. It's your annual payday. It's your opportunity to give yourself a massive raise by firing your overpriced vendor and hiring a new, more efficient one. This is the pro mindset. You don't accept the first offer. You don't let personal feelings get in the way of a business decision. And you understand that in this game, the only way to win is to always be willing to walk away. Now that you understand the game being played, it's time to learn the rules of the board. And the most important, most misunderstood, and most dangerous part of any policy are the 3 numbers that define your liability coverage. In the next part, we are going to break down exactly what those numbers mean, and I will reveal why accepting the state minimum coverage is one of the single greatest financial risks you can take. A decision that could lead to financial ruin, even if you're a perfectly safe driver. You don't want to miss it. So let's start with those 3 numbers you see on every quote, the ones that look like a secret code. They're usually separated by slashes, something like 25/50/25. This isn't random jargon. It's the absolute core of your protection. This is your liability coverage, and it has nothing to do with fixing your car or paying for your medical bills. This is the money your insurance company will pay out to other people when an accident is your fault. Breaking this code is the first step to shopping like a pro. The first number, the 25 in our 25/50/25 example, stands for $25,000. This is the maximum amount your policy will pay for any single person's medical bills in an accident you cause. Let's say you glance at your phone for just a second, you don't see the car in front of you stop, and you rear-end them. The driver, a guy named David, gets a nasty case of whiplash and a herniated disc. He needs an ambulance ride, an MRI, a few months of physical therapy, and misses a month of work. His medical bills and lost wages quickly add up to $35,000. If your policy limit is $25,000, your insurance company writes a check for $25,000, and then they wash their hands of it. They've done their job. But what about the other $10,000? That doesn't just disappear. David's lawyer will be sending you a bill for that remaining $10,000, and you will be legally required to pay it. Now for the second number, the 50. This stands for $50,000. This is the maximum total amount your policy will pay for all medical bills for everyone you injure in a single accident. Let's go back to our scenario. But this time, David wasn't alone. His wife was in the passenger seat and his son was in the back. His wife broke her wrist, and his son had a concussion. Now we have 3 people with injuries. David's bills are $35,000, his wife's are $15,000, and his son's are $5,000. That's a total of $55,000 in medical expenses. Your policy has a $50,000 total limit. So even though no single person's bills went over the individual limit, the grand total did. Your insurance pays out its max of $50,000. And that remaining $5,000? Once again, that's your personal responsibility. You're on the hook. Finally, the third number, the last 25. This is for $25,000 in property damage. This is the maximum your policy will pay to repair or replace anything you hit that isn't a person. Most people think this just means the other person's car. And in a minor fender bender with a 10-year-old Honda Civic, $25,000 might be enough. But what if you don't hit a 10-year-old Civic? What if you swerve on a wet road and hit a brand new Mercedes S-Class? The repair bill for that could easily top $40,000 or $50,000. What if you hit a Tesla? The cost to replace its specialized battery pack alone can be astronomical. Or what if you cause a multi-car pileup? That third number has to cover the damage to every single vehicle you're responsible for. What if you lose control and slide off the road, taking out a city light pole, a fire hydrant, and the front of someone's business? That's all property damage. Your $25,000 limit will be exhausted in an instant. And for every dollar of damage above that limit, they will come after you. Now let's connect this to the most dangerous trap in the entire insurance industry: the state minimum. Every state requires you to have insurance, but the minimum amount they require is terrifyingly low. It's a political number designed to make insurance accessible, not to actually protect you. In California, for example, the minimum is 15/30/5. That's $15,000 for one person's injuries, $30,000 total for an accident, and a laughable $5,000 for property damage. $5,000. That might not even cover the cost of replacing the high-tech bumper on a new pickup truck, let alone the rest of the vehicle. Let's walk through what financial ruin actually looks like, using a real-world scenario with these state minimums. Imagine you have that 15/30/5 policy because it was the cheapest option and you're a safe driver. One morning, you're driving to work. The sun is in your eyes, and you don't see a cyclist in the crosswalk until it's too late. You slam on the brakes, but you still hit them. The cyclist is a 40-year-old surgeon. She survives, but with a shattered leg that requires multiple surgeries and extensive rehabilitation. She can't work for a year. Let's do the math. The ambulance, the emergency room, the surgeries, the hospital stay, the physical therapy. Her medical bills total $175,000. Because she's a surgeon, her lost income for that year is another $300,000. The total economic damages are $475,000. Her custom-made $10,000 racing bike is also destroyed. You hand over your insurance card. Your policy, the one that fulfilled your legal requirement, pays its maximum. It pays $15,000 towards her medical bills. That's it. The other $160,000? That's on you. The $300,000 in lost wages? That's on you. The $10,000 for her bike? Your policy only has $5,000 in property damage, so it pays the $5,000, and the other $5,000 is on you. In total, you are now personally on the hook for $470,000. A lawyer sends you a letter. You don't have that kind of money, so they sue you. They get a judgment against you in court. And with that judgment, they can legally garnish your wages for the next 20 years. They can put a lien on your house, meaning if you ever sell it, they get their money first. They can seize the money in your bank accounts. They can take your investments, your retirement savings, everything you have ever worked for, and a significant portion of everything you will work for is gone. Because of one moment of sun in your eyes. And because you chose a policy that cost $10 less per month. That is what financial ruin looks like. It's not a hypothetical. It happens to good, safe drivers every single day in this country. The pro mindset isn't about finding the absolute cheapest price. It's about risk management. It's about asking one simple question. What do I have to protect? Look at your life. Do you have a savings account? Do you own a home? Do you have a 401k? Do you have a career with future earning potential? If the answer is yes to any of those, the state minimum is playing Russian roulette with your entire financial future. The goal of liability insurance isn't just to be legal. The goal is to build a financial fortress around your assets and your future income. Your liability limit should be high enough to cover your entire net worth. If you have $200,000 in assets between your home equity and savings, you need at least that much in liability coverage. So what are the right numbers? For most people, I wouldn't even consider anything less than 100/300/100. That's $100,000 for a single person's injuries, $300,000 total per accident, and $100,000 for property damage. That provides a respectable level of protection for the average person. But for the true pro, for the person who wants to be virtually untouchable after an accident, we need to go even higher. We need to look at limits like 250/500/100. Why those specific numbers? Because raising your limits to that level often unlocks the single most powerful and cost-effective tool in all of personal finance: the personal umbrella policy. This is the secret the wealthy use to protect their assets, and it's shockingly affordable. For just a few $100s a year, you can add an extra $1 million, $2 million, or even $5 million of liability coverage on top of your auto and home insurance. In the next part, we're going to break down exactly what those higher limits, like 100/300/100 and 250/500/100, will actually cost you. The difference is much, much smaller than you think. Then we're going to dive deep into the mechanics of an umbrella policy. I'll show you how this one simple addition can make you essentially lawsuit-proof from a car accident, and why it's the smartest financial decision you'll make all year. You're about to learn how to get $1 million of protection for the price of a few cups of coffee a month. This magic bullet, this financial fortress, is called a personal umbrella policy. And I know the name sounds a little weird, maybe even a bit boring. But I promise you, by the end of this section, you will see it as the single most powerful and underutilized tool in personal finance. It's the Kevlar vest you didn't know you needed. To understand its power, I want you to meet Mark. Mark is a good guy. He's 42, married, 2 kids in middle school. He's a project manager at a decent company, makes a good living. They own a nice home in the suburbs, have about $200,000 in equity built up. They've been diligently saving for retirement, got a healthy 401k, and they've even managed to put away 50 grand for the kids' college education. Mark considers himself responsible. He has full coverage car insurance. He pays his premium on time every time. He thinks he's protected. He thinks he's done everything right. One Tuesday afternoon, Mark is driving home from work. The sun is in his eyes. His phone buzzes with a text from his wife about dinner plans. For just 2 seconds, literally 2 seconds, he glances down at the screen. In those 2 seconds, the car in front of him slams on its brakes. Mark looks up, but it's too late. He swerves instinctively, clipping the first car and sending his own vehicle across the center line, directly into oncoming traffic. The crash is catastrophic. It involves 3 other vehicles. Airbags deploy, metal screams, glass shatters. When the dust settles, Mark is thankfully okay, just bruised and shaken. But the other people are not. One driver has a broken leg and a severe concussion. A passenger in another car has a spinal cord injury and will require years of rehabilitation, possibly facing partial paralysis. The medical bills begin to mount at a terrifying speed. We're talking helicopter airlifts, multiple surgeries, intensive care stays, long-term physical therapy. Mark's car insurance policy has liability limits of $100,000 per person and $300,000 per accident. On paper, that sounds like a lot of money. Mark always thought it was plenty, but in the face of a multi-victim, serious injury accident, it's a drop in the ocean. The medical bills for the spinal cord victim alone soar past $500,000 within the first few months. The other victims' bills add another $200,000. Then come the lawsuits, not just for medical expenses but for lost wages. One of the victims is a surgeon who can no longer perform operations. They sue for millions in lost future income. They sue for pain and suffering. Mark's insurance company does its job. It hires a lawyer and fights the claims. But the evidence is clear. Mark was at fault. The damages are legitimate and they are massive. So the insurance company writes a check for the maximum amount of his policy, $300,000. And then they do something that terrifies Mark to his core. They send him a letter. It basically says, "We have paid our policy limit. Our legal and financial obligation to you is now fulfilled. The remaining damages are your personal responsibility. Good luck." And just like that, the safety net is gone. The lawyers for the victims now turn their attention from the insurance company directly to Mark. They get a judgment against him for $1.5 million. His insurance paid $300,000. That leaves a $1.2 million debt hanging over his head. So what happens next? This is the part that should keep you up at night. They go after everything. First, they drain his savings and checking accounts. Then they put a lien on his house, forcing a sale to capture that $200,000 of equity he and his wife spent years building. The $50,000 for his kids' college? Gone. Seized. But it's still not enough. So the court orders a wage garnishment. For the next 25 years, a huge chunk of every single paycheck Mark earns is automatically diverted to pay off this judgment. His family's lifestyle is shattered. They have to sell their home, move into a small apartment. Retirement is a fantasy. College for the kids is off the table. Their entire financial future, everything they worked for their entire lives, was wiped out in 2 seconds because he glanced at a text message. His one mistake didn't just cause a car crash. It bankrupted his family for a generation. Now take a deep breath, because I want to rewind the clock. Let's go back to that same Tuesday. Same sun in his eyes, same text message, same horrible, tragic accident. But in this version of reality, 6 months earlier, Mark's insurance agent told him about an umbrella policy. For an extra $20 a month, the price of 4 lattes, Mark added a $1 million umbrella policy to his home and auto insurance. He barely even noticed the cost. So now the accident happens. The lawsuits pile up. The judgment comes in for $1.5 million. Just like before, his primary car insurance pays out its $300,000 limit. But this time there is no good luck letter. Instead, something amazing happens. The umbrella policy kicks in. A new team of expert lawyers, hired by the umbrella insurance company, takes over the case. They handle the negotiations. And when the final settlement is reached, the umbrella policy writes a check for the remaining $1.2 million. What happens to Mark's life? His car insurance rates go up for sure. The experience is still traumatic. But his house? It's safe. His retirement savings? Untouched. His kids' college fund? Still there. His future wages? They belong to him and his family. For $20 a month, he traded financial annihilation for a manageable problem. He bought himself a firewall. The umbrella policy stood between a devastating lawsuit and everything he had ever worked for. That is the power of an umbrella. It's not insurance for your car. It's insurance for your entire life. And here's the secret why it's so unbelievably cheap. It's what's called excess liability. It only ever gets used after your primary insurance, your auto or home policy, is completely exhausted. Because these catastrophic life-ruining events are statistically rare, the risk for the insurance company is lower, so the price they charge you is dramatically lower. You can typically get a $1 million policy for between $150 and $300 a year. Let that sink in. For less than $1 a day, you can protect $1 million of your future assets. There is no other financial product on earth that gives you that kind of leverage and peace of mind. And let me bust a huge myth right now. Umbrella policies are not just for rich people. In fact, I'd argue they are more important for middle-class families. A billionaire has lawyers and complex trusts to shield their assets. But for a family like Mark's who has a home, some savings, and a good income, you are the perfect target for a lawsuit. You have just enough to lose everything. If you own a home, if you have a 401k, if you have kids whose future you care about, you are precisely the person who needs this protection the most. It protects the life you've built and the future you're building. So how do you get one? It's incredibly simple. You call your current insurance agent, the one who handles your home and auto policies. You typically need to have both with the same company to qualify, and they'll require you to have certain liability limits on those base policies, which we're going to talk about next. You just ask them for a quote on a $1 million personal umbrella policy. It will probably take 10 minutes. And it will be the smartest 10 minutes you spend on your finances all year. Now that you understand the ultimate safety net, we need to make sure the foundation it sits on is solid. That foundation is your primary auto liability coverage. You know those confusing numbers on your policy declaration page? 100/300/100 or 250/500/250. Most people just pick one and have no idea what they actually mean in the real world. In the next part, we are going to demystify these numbers once and for all. I'm going to show you exactly how to read them, what they cover in a crash, and how to choose the precise level of protection you need without wasting a single dollar on coverage that doesn't serve you. This is where we get into the nuts and bolts that can save you thousands. Alright, let's break down your insurance policy. Think of it less like a confusing legal document and more like building a custom suit of armor for your financial life. You don't just grab one off the rack. You choose the helmet, the chest plate, the leg guards. Each piece serves a specific purpose. Get it wrong and you're exposed. Get it right and you're invincible on the road. The absolute bedrock, the foundation of every single car insurance policy in America, is liability coverage. This is the part that's not for you. I'm going to repeat that because it's the single most misunderstood concept in car insurance. Liability coverage is not for you. It's for the other guy. It's for the person you hit. It's the coverage that keeps you from being sued into oblivion when you make a mistake. It is legally required in nearly every state for this very reason: to protect the public from uninsured drivers. Liability is broken down into two critical parts. First, you have bodily injury liability, or BI. If you cause an accident and someone in the other car breaks their arm, gets a concussion, or worse, this is what pays for their medical bills. It covers their ambulance ride, their hospital stay, their surgery, their physical therapy. It can also cover their lost wages if they can't work, and even more abstract things like pain and suffering. The second part is property damage liability, or PD. This one's more straightforward. It pays to repair or replace whatever property you damaged. Most of the time, that's the other person's car. But it's not just their car. If you swerve and take out a homeowner's brick mailbox, that's covered. If you skid on ice and crash through the front of a coffee shop, your property damage liability is what pays to rebuild that storefront. Now, this is where you see those confusing numbers on your policy like 25/50/25 or 50/100/50. It's not a secret code. It's your suit of armor strength rating. Let's break down a 25/50/25 policy, which is a common state minimum. The first number, 25, stands for $25,000. That's the maximum amount your insurance will pay for any one person's bodily injuries in an accident you cause. The second number, 50, stands for $50,000. That's the maximum total amount your insurance will pay for all bodily injuries combined in a single accident. So if you hit a car with 3 people in it, your policy will pay out a maximum of $50,000 for their medical bills, with no single person getting more than $25,000. The third number, 25, stands for $25,000. That's the maximum your policy will pay for all property damage you cause in one accident. Now, I'm going to tell you the single most important piece of advice in this entire series. Are you listening? Choosing your state's minimum liability coverage is one of the biggest financial mistakes you can make. It's like going into a sword fight wearing a t-shirt. It is a catastrophic trap set for the uninformed. Let's play out a scenario. You have that 25/50/25 minimum coverage. You're driving home, you glance at your phone for a split second, and you rear end a brand new Toyota Highlander at a stoplight. It's a pretty standard family SUV. The average price of a new car in the United States is now over $48,000. Your $25,000 property damage limit? It's already exhausted. You are now personally on the hook for the remaining $23,000 to replace their car. But it gets worse. The mom driving the Highlander gets a nasty case of whiplash, and her son in the passenger seat breaks his wrist. The ambulance ride alone is $1,500. A hospital ER visit can easily top $3,000. The son needs a specialist and a cast. The mom needs weeks of chiropractic care and physical therapy. Their combined medical bills quickly soar to $30,000. Your policy covers a maximum of $25,000 per person, so you're good there, right? No. Remember the second number, the 50? That's the per accident max. So your $50,000 limit is enough to cover the $30,000 in bills. But what about the $23,000 you still owe for their totaled car? That comes out of your pocket. And what if the mom is a freelance graphic designer and can't work for 2 months because of the headaches from her concussion? That's another $15,000 in lost wages. The other driver's insurance company will pay their client, and then their lawyers will come after you for reimbursement. They will look at your assets, your savings account, your investments, the equity in your home. They can garnish your wages for years, all from a 2-second mistake at a stoplight because you tried to save a few dollars a month on a cheap policy. The pro move? Drastically increase your liability limits. A good baseline for most people is 100/300/100. That's $100,000 per person, $300,000 per accident for bodily injury, and $100,000 for property damage. The best part? The jump in price from a garbage tier minimum policy to a robust, protective 100/300/100 policy is shockingly small. We're often talking about the cost of a few cups of coffee a month to increase your protection by hundreds of thousands of dollars. It is the single best bargain in all of insurance. Okay, so that's liability. That's the armor that protects you from hurting others. Now let's talk about the coverage that protects your stuff. Your car. This is where collision and comprehensive coverage come in. These two are almost always sold together, and if you have a loan or a lease on your car, your lender will require you to have them. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, or it could be a telephone pole, a guardrail, a garage door you forgot to open, you name it. Critically, collision covers you regardless of who is at fault. If someone runs a red light and T-bones you, their liability insurance should pay for your car. But if they are uninsured or it's a complicated mess, your own collision coverage can step in, pay for your repairs immediately, and then your insurance company will go after the other driver's company for reimbursement. It gets you back on the road fast. It also covers you when you are the one at fault, like if you back into a pole. Comprehensive coverage is the other half of the coin. Think of it as acts of God or weird stuff coverage. It covers damage to your car from things other than a collision. This is your protection against theft, vandalism, fire, hailstorms that make your car look like a golf ball, flooding, or a tree branch falling on your roof during a windstorm. Hitting a deer is also typically covered under comprehensive. It's all the chaos of the world that can damage your car when it's just sitting there, or when you encounter something unexpected on the road. Now, with both collision and comprehensive, you have to choose a deductible. The deductible is the key to managing your cost. It's the amount of money you agree to pay out of pocket for a claim before the insurance company pays. A single-cent deductibles typically range from $250 to $2,000. Here's how it works. Let's say you have a $500 deductible for your collision coverage. You get into an accident that causes $4,000 worth of damage to your car. You pay the first $500 to the body shop, and your insurance company pays the remaining $3,500. This is a powerful lever you can pull to control your premium. A lower deductible, like $250, means you pay less in a claim, but you'll pay a higher monthly premium for that privilege. A higher deductible, like $1,000, means you'll pay a much lower monthly premium, but you're taking on more risk and will have to pay more if you have an accident. So how do you choose? Here's the pro tip. Select the highest deductible you can comfortably afford to pay tomorrow, in cash, without causing a financial crisis. If you have a healthy emergency fund of several $1,000s, a $1,000 or even $1,500 deductible can save you a significant amount of money on your premiums over the years. But if a surprise $1,000 bill would force you to go into credit card debt, you should choose a lower deductible like $500. Be honest with yourself about your financial situation. Finally, when should you get rid of collision and comprehensive altogether? As your car gets older, its value drops. At some point, the amount you're paying to insure the car against damage might be more than the car is even worth. A good rule of thumb is the 10% rule. If the annual cost for your collision and comprehensive coverage is more than 10% of your car's cash value, it may be time to drop them. For example, if your car is only worth $4,000 and your collision/comprehensive package costs $500 per year, that's over 10%. You might be better off banking that $500 a year and accepting the risk that if you wreck the car, you'll have to pay to replace it yourself. So now you understand the core of your policy. You have liability to protect you from lawsuits when you hurt someone else, and you have collision and comprehensive to fix your own car. You've built the main chassis of your financial armor. But what about the most important thing inside the car? You. What about your own medical bills, regardless of who's at fault? What happens if the person who hits you has no insurance at all? For that, you need a different set of shields entirely, and that's exactly what we're going to build next. Let's start with the first shield. The one that protects you and everyone inside your car. This isn't about the other guy anymore. This is about your own well-being. We're talking about two coverages that sound similar but do slightly different things. Medical payments coverage, or MedPay, and personal injury protection, or PIP. Think of these as your personal on-call medic for a car accident. Imagine this. You're in a minor fender bender at a four-way stop. It's chaotic. You both swear you had the right of way. While you're arguing, you realize your wrist is throbbing. It's probably just a sprain, but it needs an X-ray. Who pays for that trip to the emergency room? You could use your health insurance, sure. But what's your deductible? $1,000? $3,000? $5,000? You'd have to pay that out of pocket before your health insurance even kicks in. This is where MedPay swoops in. MedPay covers medical expenses for you and your passengers, regardless of who was at fault. It's the no questions asked medical fund. It pays for the ambulance ride, the ER visit, the X-rays, the follow-up appointments. And here's the beautiful part. It often pays first before your health insurance. It can pay your health insurance deductible for you. It's relatively inexpensive, and even a small amount, say $5,000 of coverage, can be an absolute lifesaver, preventing a minor injury from becoming a major financial headache. It also covers your passengers. Think about that. If you're driving your friends to lunch and get into an accident, do you really want them to have to sue you or use their own insurance for their injuries? MedPay handles it. No awkwardness, no destroyed friendships. Now, if you live in what's called a no-fault state, you'll have something even more robust. Personal injury protection, or PIP. PIP is like MedPay on steroids. It doesn't just cover medical bills. The P in PIP is the key. It protects your person. This means it can also cover lost wages if you can't work because of your injuries. It can cover essential services you can no longer perform, like childcare or house cleaning. In a no-fault state, your own PIP coverage is your first line of defense for your own injuries, which is designed to speed up the claims process and keep smaller injury claims out of the courts. Whether you have MedPay or PIP depends on your state, but the principle is the same. It's about protecting your body and your wallet from immediate medical costs, without waiting for the slow, grinding gears of the legal system to decide who was to blame. So you've got a shield for your immediate medical needs. That's a huge step. But what about the bigger picture? What happens when the person who hits you isn't just at fault, but is a ghost? I'm talking about the uninsured driver. According to the latest data, roughly 1 in every 8 drivers on the road in the United States has no car insurance. 1 in 8. Look around you on your next commute. The car in front of you, the truck to your left, the 7 cars behind you. Statistically, one of them is driving illegally, with zero ability to pay for the damage they might cause. They are a financial time bomb waiting to go off. And if they hit you, their lack of responsibility suddenly becomes your catastrophic problem. This is where the second and arguably one of the most important shields in your entire policy comes into play: uninsured and underinsured motorist coverage. Let's call it UM/UM. Let's break it down. Uninsured motorist coverage protects you when you're hit by a driver with no insurance at all. This includes hit-and-run drivers, where you can't even identify the person who crashed into you and fled. Let's paint a picture. Someone runs a red light and T-bones you in an intersection. It's a serious crash. Your car is destroyed, and you have significant injuries requiring surgery and months of physical therapy. The other driver is clearly at fault. The police show up, and it turns out the driver has no license, no registration, and certainly no insurance. What happens now? Their non-existent liability insurance can't pay your medical bills. It can't compensate you for your lost income while you recover. It can't give you a dime for the permanent limp you now have. You can try to sue them personally, but let's be realistic. Someone driving without insurance is unlikely to have a 6-figure stock portfolio you can liquidate. You'll win a piece of paper, a judgment that's worth absolutely nothing. This is what uninsured motorist bodily injury coverage is for. It is, in effect, you buying liability insurance for the ghost. It steps into the shoes of the uninsured driver and pays you for your medical bills, your lost wages, and your pain and suffering, up to the limits you select. It is the only thing standing between you and financial ruin in this all-too-common scenario. But there's a second, more sneaky kind of ghost: the underinsured driver. This is the person who did the bare minimum. They bought car insurance, but only the lowest amount required by state law. In some states, the minimum bodily injury liability is a shockingly low $15,000 or $25,000 per person. Let's replay our accident scenario. The driver who T-boned you does have insurance. Phew, right? Wrong. They have the state minimum of $25,000. But your medical bills alone are $90,000. Their insurance company will write you a check for $25,000, and that's it. That's all they are legally obligated to pay. You are now personally on the hook for the remaining $65,000, not to mention your lost wages and everything else. This is where underinsured motorist coverage, the UIM, saves the day. It bridges the gap. It kicks in after the other driver's insurance maxes out and pays the rest, again, up to the limits you selected on your own policy. So, what is the single most important pro tip I can give you about this coverage? It's something almost nobody thinks about, but it is the absolute golden rule of buying car insurance. Ready? You should always have your uninsured and underinsured motorist coverage limits match your own bodily injury liability limits. Let me say that again. Match your UM/UIM limits to your liability limits. Think about the logic here. When you chose your liability limits, let's say you picked $250,000 per person and $500,000 per accident, you made a conscious decision. You decided that you have assets and a future income worth protecting up to that amount, in case you cause a serious accident. You valued the protection of a stranger's health and well-being at $250,000. So here is the million-dollar question. If you believe a stranger deserves $250,000 of protection from you, why would you believe that you deserve less protection from them? Why would you protect a stranger from your mistake more than you protect yourself and your family from a reckless, uninsured driver? It makes zero logical sense. Yet, millions of people carry high liability limits and the bare minimum on their uninsured motorist coverage, creating a massive, nonsensical gap in their own protection. They've built a fortress to protect everyone outside, but left the front door of their own castle wide open. Matching these limits is the ultimate pro move. The cost to increase your UM/UIM limits is usually a tiny fraction of your total premium, yet it provides an exponentially larger safety net. It is the single best value purchase you can make on your entire policy. So let's recap our fortress. We've built the outer walls with liability insurance to protect everyone else. Now we've added 2 critical inner shields: The first is MedPay or PIP, your personal medic to handle immediate injuries for you and your passengers, no matter the fault. The second is your Elite Guard UM/UIM coverage to protect you from the financial devastation caused by the ghosts of the road, the uninsured and the underinsured. We've protected other people's bodies. We've protected our own bodies. We've protected other people's property. But we've completely ignored the single most expensive, tangible asset involved in this whole equation. Your 1,000-pound hunk of steel, glass, and technology sitting in the driveway. What happens when it gets damaged? What if the accident is your fault? What if a tree falls on it in a storm? Or a shopping cart rolls into it? Or you walk out one morning to find nothing but an empty parking spot? For that, you need the final 2 shields in our core protection package, and this is where the biggest trade-offs between cost and coverage really come into play. Let's start with the first shield, collision coverage. This one is pretty straightforward. Collision pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a guardrail, a telephone pole, or the garage door you forgot to open. The key thing to remember about collision is that it pays out regardless of who is at fault. If you cause the accident, your liability coverage is busy paying for the other guy's brand new SUV. Your collision coverage is what steps in to fix your car. If the other driver is at fault but they're uninsured, and you need your car fixed now instead of waiting months to sue them, collision coverage is your fast track. It gets you back on the road, and then your insurance company will go after the at-fault driver to get their money back. But here's the catch. This is the first time we're going to talk about a word that changes everything. The deductible. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance company pays a single penny. Think of it as your share of the risk. Let's say you have a $500 deductible. You swerve to avoid a squirrel and hit a mailbox, causing $3,000 in damage to your front end. You file a collision claim. The body shop gives you the bill for $3,000. You pay the first $500 directly. Then your insurer pays the remaining $2,500. If the damage was only $400, you're paying for all of it yourself. Your insurance doesn't get involved because the cost of the repair is less than your deductible. Now, this is where the trade-off comes in, and it's one of the most powerful levers you have to control your insurance premium. The higher your deductible, the lower your monthly or semi-annual premium will be. The lower your deductible, the higher your premium. Why? Because by choosing a higher deductible, you're telling the insurance company, I'm willing to take on more of the financial risk myself in a small accident, so you only have to worry about the big stuff. This makes you a less risky customer in their eyes, so they give you a better price. You'll typically see deductible options like $250, $500, $1,000, or even $2,000. So which one should you choose? A lot of people just pick $500 because it feels like a default. This is a mistake. The pro move is to ask yourself one simple question. What is the largest lump sum of cash I could comfortably pay out tomorrow without derailing my finances if my car gets wrecked? If your answer is $500, then that's your deductible. But if you have a healthy emergency fund and could easily write a check for $1,000, you should get a quote for a $1,000 deductible. The premium savings can be significant, often $100 to $200 a year or more. You're essentially making a bet on your own driving. Don't set a $1,000 deductible just to save $15 a month if you don't actually have that $1,000 ready to go. That's a recipe for financial disaster. Your deductible should match your reality, not your wishful thinking. Okay, so collision covers you when you hit something. But what about all the other forms of chaos the universe can throw at your car? What about the hailstorm that makes your hood look like a golf ball? The shopping cart that a gale force wind sends hurtling across the parking lot? The deer that decides to play chicken with you on a country road at midnight? Or the thief who smashes your window and steals your catalytic converter? For all of that, you need the second shield, comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It's for almost any damage to your car that isn't caused by a collision. This includes theft, vandalism, fire, floods, falling objects like tree branches, riots, and crucially, hitting an animal. This is a point of confusion for a lot of people. If you swerve to miss a deer and hit a tree, that's a collision claim. If you hit the deer, that's a comprehensive claim. It's a weird distinction, but it can make a difference because comprehensive claims are generally seen as being outside of your control, so they're less likely to raise your rates than an at-fault collision claim. Just like collision, comprehensive coverage has its own deductible, and it works the exact same way. You can even choose different deductibles for each. It's very common for people to have a higher deductible for collision, say $1,000, and a lower one for comprehensive like $250 or $500. This can be a smart strategy. The odds of a catastrophic multi-thousand-dollar collision are higher than a total loss from hail, so you take on more risk there to save on the premium. But you keep the comprehensive deductible low for those more frequent, annoying claims like a cracked windshield or a stolen catalytic converter. Now for the biggest question of all, the one that can save you hundreds if not thousands of dollars over the life of your car. Do you even need collision and comprehensive coverage? Unlike liability insurance, which is required by law in nearly every state, these two coverages are almost always optional. There's one major exception. If you have a loan or a lease on your car, the lender will absolutely require you to carry both. They have a financial stake in that vehicle, and they need to make sure their asset is protected until you pay it off. But if you own your car outright, if the title is in your name with no lien holder, the decision is entirely yours. And this is where you have to stop thinking like a consumer and start thinking like a CFO of your own life. The decision to carry collision and comprehensive should be based on a simple cost-benefit analysis of your car's value. The key phrase here is actual cash value, or ACV. This is what your car was worth the second before the accident occurred. It's not what you paid for it. It's not what a new one would cost. It's the depreciated market rate value, taking into account its age, mileage, and condition. If your car is declared a total loss, the insurance company will write you a check for its ACV, minus your deductible. So here's the rule of thumb many financial experts use. If the annual cost for your collision and comprehensive coverage exceeds 10% of your car's actual cash value, you should seriously consider dropping it. Let's run the numbers. Imagine you have a 12-year-old sedan. You look it up on Kelley Blue Book, and it's worth about $4,000. You check your insurance policy and see that you're paying $600 a year just for the collision and comprehensive portion of your premium. $600 is 15% of $4,000. In this scenario, you're paying a huge chunk of your car's total worth every year just for the privilege of insuring it against damage. If you keep that car for 3 more years, you'll have paid another $1,800 in premiums, almost half the car's value. In that situation, the pro move might be to drop collision and comprehensive, take that $600 a year you're saving, and put it into a dedicated car replacement savings account. You are now self-insuring. You are accepting the risk that if you wreck the car, you'll have to repair or replace it entirely on your own dime. It's a calculated risk. But if you're a safe driver and that $4,000 isn't going to bankrupt you, it can be a financially savvy decision. Conversely, if your car is only 3 years old and worth $30,000, paying $800 a year for full coverage is a no-brainer. The risk of losing a $30,000 asset is far too great to self-insure. This is not a one-size-fits-all answer. It's a deeply personal decision based on your car's value, your savings, and your tolerance for risk. But failing to even ask the question is like throwing money away. Every year, when your policy comes up for renewal, you should take 5 minutes to check your car's value and reevaluate if these coverages still make sense for you. So now we have our 5 core shields: liability for others, uninsured motorists for you, and collision and comprehensive for your car. This is the foundation. This is what most people would call full coverage. But the standard policy leaves some massive, financially devastating gaps. What happens when your medical bills skyrocket past your coverage limits? Or what if you need a rental car for 3 weeks while yours is in the shop? These aren't luxuries, they're necessities. And in the next part, we're going to plug those gaps with the optional coverages that separate the amateurs from the pros. So let's talk about that rental car. Imagine this: you're driving home, a deer jumps out, and you swerve to miss it but still clip it. Your car is drivable, but the whole front end is a mess. You take it to the body shop and the mechanic gives you that look. You know the one. He sucks air through his teeth and says, "Oof. With the supply chain these days, we're waiting on a specific sensor from Germany. It's gonna be at least 3, maybe 4 weeks. 4 weeks. A month without a car. How do you get to work? How do you get your kids to school? You have to rent a car. The average cost for a rental car in the US is climbing. Let's call it $70 a day. For 30 days, you are looking at a $2,100 bill. That's a bill your standard insurance policy will not pay. You're on your own, unless you have rental reimbursement coverage. For the cost of a fancy cup of coffee each month, maybe $5 or $6, you can add a safety net. This coverage typically gives you a daily allowance, say $50 a day, for up to 30 days. Suddenly, that $2,000 nightmare bill shrinks to almost nothing. You pay the small difference and you get on with your life. This isn't a luxury. In a world of parts shortages and backed-up repair shops, it's a critical tool for survival. A pro doesn't get stranded. Pro has a backup plan. And while we're on the topic of being stranded, let's talk about the single most frustrating moment in a driver's life. The moment you turn the key and hear nothing. A dead battery. Or maybe it's a flat tire on the side of the interstate at 10 p.m. Or you're in a rush, you shut the door, and you see your keys sitting right there on the driver's seat. These are the moments where you have two choices. You can frantically search on your phone for a local tow truck, wondering if they're going to charge you $200 just to show up, or you can make one calm phone call. That's the power of roadside assistance. This is another one of those optional coverages that costs pennies but delivers dollars in peace of mind. For a few bucks a month, you get access to a 24/7 hotline that can dispatch a truck to tow you to a mechanic, change your flat tire, jumpstart your dead battery, bring you a gallon of gas if you run out, or even get a locksmith to retrieve your keys. The cost of one single tow service can often be more than the cost of an entire year of this coverage. It's the ultimate get-out-of-jail-free card for drivers. You're not just buying a service. You're buying the guarantee that you'll never be left helpless on the side of the road. Hey, let's shift gears. We've handled the inconveniences. Now we need to talk about the catastrophes. We need to talk about the single most important optional coverage you can buy. The one that can prevent a car accident from completely destroying your financial future. I am talking about uninsured and underinsured motorist coverage. Let this sink in. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means in any decent-sized traffic jam, you are likely surrounded by people who have zero ability to pay for the damage they might cause. Now picture it. You're driving responsibly. You have the green light. A car blows through the red light and T-bones you. It's a bad one. You're rushed to the hospital. You have serious injuries, broken bones, a long recovery ahead. Your medical bills quickly soar past $100,000. You're going to be out of work for 6 months. The police report comes back. The other driver was 100% at fault, and they have no insurance. So who pays? Who pays for your hospital stay? Your surgeries? Your physical therapy? Who replaces the 6 months of income you just lost? The at-fault driver? They can't. They have no money, no assets. That's why they didn't have insurance in the first place. You can sue them, but you can't get blood from a stone. This is where uninsured motorist coverage, or UM, becomes your hero. It is insurance you buy for yourself in case the other guy doesn't have any. Your own UM coverage steps in and plays the role of the at-fault driver's insurance. Pays for your medical bills. Pays for your lost wages. It pays for your pain and suffering up to the limits you selected. Without it, you are on your own. But there's a second, more sinister part to this. Underinsured motorist coverage, or UIM. This is for the person who follows the law but just barely. They buy the absolute state minimum liability coverage. Let's say their policy only covers $25,000 for bodily injury. Using our same example, your medical bills are $100,000. Their insurance will pay out its maximum of $25,000, and then they're done. They wash their hands of it. You are still left with a $75,000 hole, not to mention all your lost wages. That's when your underinsured motorist coverage kicks in. It covers the gap between their pathetic limit and your actual damages, again, up to the limit you chose on your own policy. This is why the pro move, the non-negotiable rule, is to always set your uninsured and underinsured motorist limits to be equal to your bodily injury liability limits. If you have a policy that will pay out $250,000 if you hurt someone else, you need to have a policy that will pay out $250,000 if an uninsured or underinsured driver hurts you. You have to protect your own family as robustly as you protect a stranger. Do not skip this. Do not cheap out on this. It is your financial life raft. Now, closely related to this are 2 other coverages: medical payments, or MedPay, and personal injury protection, or PIP. Think of these as the first responders of your insurance policy. Unlike UM/UIM, which requires proving the other driver was at fault and uninsured, MedPay is no-fault coverage. It doesn't matter who caused the accident. If you are injured in your car, or even as a pedestrian hit by a car, MedPay helps pay for your immediate medical expenses. It covers things like the ambulance ride, the ER visit, x-rays, and your health insurance deductible. It pays out quickly without a lengthy investigation, getting you the cash you need for those initial bills. Personal injury protection, or PIP, is like MedPay on steroids. It's required in many no-fault states and it's more comprehensive. In addition to medical bills, PIP can also cover a portion of your lost wages and even expenses for things like childcare if you're unable to perform your normal duties while you recover. It's designed to get you and your family back on your feet fast. Okay, one last major one, and this is for anyone financing or leasing a new car. It's called gap insurance. And to understand it, you need to understand the brutal reality of depreciation. The second you drive a brand new $40,000 car off the dealer's lot, it's no longer worth $40,000. It might only be worth $36,000. Let's say you put $2,000 down and finance the other $38,000. Fast forward 6 months. You've made some payments and you now owe $36,500 on your loan. But the car's actual market value has dropped to $31,000. Then disaster strikes. Your car is stolen and never recovered, or you're in an accident and it's declared a total loss. Your comprehensive or collision coverage will pay you the actual cash value of the car. They'll write you a check for $31,000. That's great, but you still owe the bank $36,500. The insurance check goes to the bank, and you are still on the hook for the remaining $5,500. You now have no car, and a $5,000 bill for a vehicle that doesn't exist anymore. That difference, that chasm between what you owe and what the car is worth, is the gap. And gap insurance is what fills it. It pays off that remaining loan balance so you can walk away clean without debt. If you are putting less than 20% down on a new car, or if you are leasing, gap insurance isn't just a good idea. It is an absolute necessity. From rental cars to roadside rescues, from phantom drivers to financial gaps, these optional coverages are the layers of armor that a pro uses to build a truly bulletproof policy. This is how you transform a basic, flimsy piece of paper into a powerful shield that protects your health, your property, and your financial well-being. Now that we've custom-built this perfect, comprehensive policy, the big question looms: how do we actually afford it? It sounds expensive, but it doesn't have to be. The price of insurance isn't set in stone. It's a complex game, and the key to winning that game is knowing about the dozens of hidden discounts, credits, and deductions that most people don't even know exist. And in the next part, we're going to pull back the curtain and show you how to find every single one of them. Alright, grab a pen, open a notes app on your phone, because this is the part that could literally save you hundreds, if not thousands of dollars over the next few years. This isn't just a list. This is your treasure map. We're going to break these discounts down into 4 categories, so you can build your own personalized savings checklist. Let's start with the first and most important category: discounts based on you, the driver. The most obvious one is the good driver, or safe driver discount. Every company has one. But what does it mean? Typically, it means you've been accident-free and violation-free for the past 3 to 5 years. This is the foundation of a low premium. If you have a clean record, you should be getting the maximum discount here, sometimes as high as 25 or even 30%. Don't just assume you have it, verify it. Ask the agent, am I receiving the maximum good driver discount? Next, for those of you in school or with kids in school, is the good student discount. This is a classic, but people often forget about it. If you or a driver on your policy is a full-time high school or college student between 16 and 25 and maintains a B average or a 3.0 GPA, you can often get a 10 to 15% discount. You'll need to provide a report card or transcript, but for the savings, it's absolutely worth the 5 minutes it takes to find it. And here's a pro tip. Some insurers have a student away at school discount. If your child is at a college more than 100 miles away and didn't take a car with them, you can get a massive discount because their risk of driving is practically zero. Now let's talk about being proactive. Taking an approved defensive driving course can knock 5 to 10% off your premium. These courses can often be done online in a few hours. Yes, they can be a bit boring, but think of it this way: you're not paying for the course, you're investing a few hours to get a discount that pays you back year after year. Here's one most people completely miss: your profession. Are you a teacher, an engineer, a scientist, a doctor, a nurse, a police officer, a firefighter, or a first responder? Many insurance companies have affinity group discounts for people in these so-called low-risk professions. The logic is that people in these careers tend to be more responsible. The same goes for military members and veterans. The military discount is often one of the most generous they offer, so if you've served, make sure you're asking for it. It's a small way of being thanked for your service that can save you a lot of money. Okay, let's move on to the second category: discounts related to your vehicle. This is where knowing the specifics of your car pays off. First, safety features. Does your car have anti-lock brakes, automatic daytime running lights, or a full suite of airbags? These are standard on most new cars, but on older models they were options. Each one can chip away at your premium. But the big one here is the anti-theft device discount. If your car has a passive alarm system that arms itself automatically, or a vehicle recovery device like a LoJack, that's a discount. Even something as simple as getting the VIN etched into your windows can qualify with some carriers. You're making your car harder to steal, so the insurance company rewards you for lowering their risk of a total loss payout. Is your car new? Many companies offer a new car discount for vehicles that are less than 3 years old. The thinking is that new cars are more reliable and have the latest safety features. And on the flip side of that, are you driving a green vehicle? As electric and hybrid cars become more popular, so does the alternative fuel discount. Insurers want to encourage eco-friendly driving, and they'll give you a small price break for it. Now for our third category, and this is where you can take real control. Discounts based on your policy structure. The king of all discounts, the one you've definitely heard of, is the multi-policy or bundling discount. Combining your auto insurance with your home, renters, or life insurance policy from the same company is almost always the single biggest discount you can get. It can be anywhere from 10 to 25% off your entire premium. If you have renter's insurance that costs you $12 a month but it saves you $20 a month on your car insurance, you're literally getting paid to have it. Right behind that is the multi-car discount. Insuring more than one vehicle with the same company will always be cheaper than insuring them separately. But here's where people lose money. They forget to ask about the paid-in-full discount. Insurance companies love getting their money up front. If you can afford to pay your entire 6-month or 1-year premium at once instead of in monthly installments, you can often save 5 to 10% right off the top. They save on billing costs, and you avoid potential monthly service fees. It's a win-win. And here are 2 of the easiest discounts on the planet: paperless billing and autopay. Just by agreeing to receive your documents via email and having your payment automatically deducted from your bank account, you can get a small, but effortless, discount. It's free money. While you're at it, ask about a loyalty discount. If you've been with the same company for 3 or more years, you should be getting rewarded for it. And if you're switching companies, ask if they have an early shopper or advanced quote discount. Signing up for your new policy 7 to 10 days before your old one expires can sometimes snag you an extra discount just for being organized. Okay, deep breath. We've covered a lot, but now we've arrived at the 4th and final category: the truly hidden gems. These are the discounts that separate the amateurs from the pros. First, the homeowner discount. This is one of my favorites. Even if you don't bundle your home insurance with your auto policy, many companies will give you a discount on your car insurance just for being a homeowner. Why? Because their data shows that homeowners are statistically more stable and less risky to insure than renters. You just have to prove you own a home and boom, instant savings. Next, let's talk about your other affiliations. Are you a member of a wholesale club like Costco or Sam's Club? A credit union? An alumni association from your college? A professional organization like the American Medical Association or the Bar Association? Many of these groups have negotiated special discount rates with insurance carriers for their members. You could be sitting on a 5 or 10% discount just because of a membership you already have. And finally, the modern-day game changer: telematics or usage-based insurance. This is where you allow the insurance company to monitor your driving habits, either through a small device you plug into your car or an app on your smartphone. It tracks things like how many miles you drive, your speed, how hard you brake, and what time of day you're on the road. Now, I know what you're thinking: privacy. And that is a valid concern. You have to decide if the trade-off is worth it for you. But for safe, low-mileage drivers, the savings can be astronomical, up to 40% in some cases. It's the ultimate way to prove you're a safe driver and pay a rate based on your actual behavior, not just your demographic profile. If you work from home and barely drive, this could cut your bill in half. So there it is, your checklist: good driver, good student, defensive driving, your profession, your car's safety features, bundling, paying in full, being a homeowner, your alumni association, and even letting them track your driving. The average person qualifies for at least 10 of these and probably only gets 3 or 4. The key is that insurance companies will almost never volunteer these discounts. They won't call you up and say, "Hey, did you know you're an engineer and we can save you $80 a year?" You have to be your own advocate. You have to go into the conversation armed with this checklist and ask for every single one you qualify for. So now you have the ultimate checklist of discounts. You have the ammunition. But having the ammunition is useless if you don't know how to aim. In the next part, we'll show you exactly who to talk to, an agent, a broker, or a direct-to-consumer website, and what to say to turn this list into actual cash back in your pocket. So you have your list. Your coverages are defined, your driving history is clean, and you've got a checklist of every possible discount you qualify for. This is your arsenal. Now it's time to choose your battlefield and your weapon. You have 3 primary ways to buy car insurance in 2026, and the pro-level strategy isn't to pick one. It's to master all 3 and make them compete for your money. First, let's talk about the most traditional route, the captive agent. This is the person with a local office, their name on a sign, representing one single company, like State Farm, Allstate, or Farmers. Think of them as a specialist. They know their company's products inside and out. Their superpower is uncovering obscure discounts buried deep within that one company's system. They might know about a tiny discount for having a certain type of roof on your house that can be bundled, or a loyalty program that isn't advertised online. The big advantage here is the relationship. When you have a problem, you call a person, not a 1-800 number. They can be a valuable advocate during a claim. The downside? They are captive. Their loyalty is to their company. They can't tell you if a competitor across the street is offering the exact same coverage for 30% less. They can only sell you what's on their shelf. Next, you have the independent agent or broker. This is your hired gun. They don't work for one insurance company. They work for you. They have appointments with dozens of different carriers. You give them your information once and they shop it across the market, from big names to smaller regional companies you've never even heard of. Their superpower is breadth. They can find a home for almost any driver, whether you have a perfect record or a few blemishes. They save you the immense hassle of filling out 10 different online applications. The potential downside? They don't have access to every single company. The big direct-to-consumer players like Geico and Progressive typically don't work with brokers. Also, while they know a lot about many companies, their knowledge of any single one might not be as deep as a captive agent's. Finally, there's the direct-to-consumer route. This is you on your laptop at 11 p.m. going straight to the source, progressive.com, geico.com, esurance.com. You are the agent. The superpower here is speed, control, and often the lowest initial price. By cutting out the agent's commission, these companies can pass some of those savings on to you. You can tweak coverages, see prices change in real time, and buy a policy in under 15 minutes. The risk, and it's a massive one, is that you are the agent. There is no one to advise you. There is no one to say, hey, for an extra $6 a month, you can triple your liability coverage, and you really should. It's incredibly easy to underinsure yourself just to get that rock-bottom price you see on the screen. And when you need service, you're entering the world of call centers, which can be a lottery. So, captive agent, independent broker, or direct website. The amateur picks one. The pro uses all 3 in a strategic 3-step assault. Step 1. Establish the market. You start broad. Your first move is to contact an independent broker. Give them your detailed list of coverages and your discount checklist. Say, this is exactly what I want. Please find me the best 3 quotes you can from your carriers. This single action does 80% of the shopping for you. Within a day or 2, you'll have a clear picture of what the traditional insurance market thinks you're worth. You now have your benchmark. Let's say the best offer from the broker is a policy for $1,000 for 6 months. This is your number to beat. Step 2, challenge the machines. Now you take that $1,000 benchmark and go direct. You personally visit the websites of the big direct-to-consumer companies that the broker couldn't quote. You meticulously fill out their forms, ensuring every detail matches the policy the broker quoted you. This is critical. You must compare apples to apples. Same liability limits, same deductibles, same rental reimbursement. You apply every single discount from your checklist. Maybe you find a quote for $950. Excellent. You've just saved $50. Your new number to beat is $950. Most people would stop here. They take the win and buy the policy. But the final step is where the pros turn a good deal into an unbeatable one. Step 3, the final showdown. You now take your winning $950 quote, and you pick up the phone. You call a captive agent. This could be your current agent if you have one, or an agent from a major reputable company you'd like to be with. This is where your preparation pays off, and you need to use a specific script. Don't just call and ask for a quote. that makes you a passive shopper. You need to frame the conversation from a position of power. It sounds like this. Hi there. My name is your name, and I'm finalizing my car insurance decision today. My current best offer for a 6-month policy is $950 with company name. The coverages are 100/300/100 for liability, with a $500 deductible on both collision and comprehensive, and includes rental and roadside. I'm calling you because I've heard good things about your company, and I wanted to give you a final opportunity to see if you can match or, ideally, beat that offer. Do you see the difference? You've just done 3 critical things. 1, you've established a deadline, today, signaling you are a serious buyer, not a window shopper. 2, you've anchored the negotiation. The agent isn't starting from scratch. Their target is $950. Their brain is now wired to figure out how to get to that number. 3, you've shown you've done your homework by stating the exact coverages, which tells them you're an informed consumer they can't fool with a cheaper, lower coverage policy. But you don't stop there. While they're plugging in the numbers, you continue. Just to make sure we're getting every possible discount, I want to confirm a few things. My vehicle has anti-lock brakes and daytime running lights. I'm a member of AAA. My credit score is excellent. I'm also open to installing a telematics device like your Drive Safe and Save program if it provides a meaningful upfront discount. Can you please ensure all of those are being applied? You're not asking them what discounts they have. You're telling them which ones you deserve. You are directing the process. Then, after the agent comes back with a number, whether it's higher or lower, you ask the final killer question. Thank you for that. Is that the absolute best you can do? Are there any other combined policy, pay in full, or paperless billing discounts we could use to get that number just a little bit lower? And then you do the most powerful thing of all, you stay silent. You let them work. You've given them a target, you've given them the tools, and you've made it clear you're ready to buy. This structured approach completely flips the script. You're no longer a price taker at the mercy of the system. You are a professional negotiator, orchestrating a competition for your business. By following this 3-step process, you ensure that no stone is left unturned. You've leveraged the breadth of a broker, the raw pricing power of direct insurers, and the deep specialized knowledge of a captive agent. You've made them all work for you. You now have in your hands the absolute best possible price for the exact coverage you need. You're ready to make the purchase. But hold on, because getting the best price is only half the battle. The policy document itself is a minefield of exclusions and gotchas that can make a cheap policy worthless when you actually need it. Before you pay a single cent, you have to complete the final, most critical step that almost everyone skips. In our final part, we'll reveal the hidden red flags in the policy fine print that you absolutely must find before you sign on the dotted line. Alright, you've done the hard work. You've compared the quotes, you've bundled your policies, you've negotiated with agents. You're holding that final offer in your hand, the one that looks perfect on paper. The price is right, the coverage limits seem generous. But this document, this digital contract, is a minefield. It was written by an army of lawyers, not to be easily understood, but to be legally airtight for them. And buried deep within its dense, mind-numbing pages are the tripwires, the trapdoors that can turn your dream deal into a financial nightmare the moment you actually need it. So let's arm you with a magnifying glass and a translator, and hunt for the 5 critical red flags hidden in the fine print. First, and most importantly, you need to find the exclusions section. This is, without a doubt, more important than the what's covered section. Insurers love to give with one hand and take away with the other. They'll sell you a comprehensive policy, but the exclusions page is where they list all the specific scenarios where that comprehensive coverage magically disappears. What are you looking for? Start with custom equipment. Did you install a new stereo system, expensive rims, or a custom paint job? Most standard policies will not cover these modifications unless you have a specific endorsement, called a rider. Without it, if your car is stolen, they'll pay to replace a factory radio, not your $2,000 sound system. Another huge exclusion is business use. If you use your personal vehicle for work, even occasionally, like for delivering pizzas, driving for a rideshare service like Uber or Lyft, or even just running errands as a freelance consultant, your personal policy may completely deny a claim if an accident happens while you're on the clock. They will argue you needed a commercial policy. You must find the exact language defining business use, and ensure your daily life doesn't accidentally void your entire policy. Look for anything that seems oddly specific, like exclusions for racing, off-roading, or even damage from nuclear hazards or acts of war. While some seem obvious, others can be sneakily relevant, and knowing what isn't covered is the first step to true protection. The second red flag is hiding in the definitions section. This is where the insurance company defines the words they use, and their definitions might be wildly different from yours. The number one term to find is actual cash value, or ACV. When an insurer says they'll pay the actual cash value for your totaled car, they don't mean what you paid for it, or even what it costs to buy another one just like it. They mean the market value of your car 1 second before the crash, minus depreciation. For a car that's even a few years old, the ACV payout can be thousands of dollars less than what you need to buy a comparable replacement. This is the gap that gap insurance or new car replacement coverage is designed to fill. If you paid for that extra coverage, you must verify that the definition and terms in the policy match what the agent promised you. Also, look up their definition of OEM parts. OEM stands for Original Equipment Manufacturer. These are the parts made by your car's brand, a genuine Ford part for your Ford truck. The alternative is aftermarket parts, which are cheaper third-party copies. Most standard policies by default will only pay for aftermarket parts in a repair, especially if your car is more than a year or two old. If you want the guarantee of original factory parts, you need an OEM endorsement. The fine print will tell you their default procedure. If you see language like parts of like kind and quality, or non-OEM parts, you need to understand that your car may be repaired with generic components unless you've explicitly paid for the upgrade. Third on our list is a section that's often called duties after a loss. This is your rulebook for what to do when disaster strikes. And if you break any of these rules, they can legally deny your claim, even if it's perfectly valid. Read this section twice. It will specify a time frame for reporting the accident. Is it promptly, immediately, or within 24 hours? Don't assume you have weeks to get your story straight. It will also state that you must cooperate fully with their investigation. This means providing recorded statements, signing medical release forms, and giving them access to the vehicle. Critically, it will also include a clause about protecting the vehicle from further loss. This means if your car is in a wreck and a window is smashed, you're responsible for putting a tarp over it to prevent rain from ruining the interior. If you just leave it in a tow yard to get soaked for a week, the insurer can refuse to pay for the water damage, arguing that your negligence caused it. Know your duties. They are not suggestions. They are contractual obligations. The fourth red flag is about your freedom, specifically your freedom to choose a repair shop. Scan the policy for any mention of direct repair programs, preferred facilities, or select service centers. These are networks of auto body shops that have contracts with the insurance company. The insurer will heavily pressure you to use one of their shops, promising a faster, smoother process and a lifetime warranty on the repair. And while that can be true, there's a catch. These shops get a high volume of business from the insurer, which can create pressure to keep costs low, potentially by using cheaper parts or faster, but not always better repair techniques. Your policy must state whether you have the right to go to a mechanic of your own choosing. In most states, it is illegal for them to force you to use their preferred shop. However, they can make it difficult if you don't. They might require more documentation, send their own adjuster out for a separate inspection, and drag out the payment process. Understand the language in your policy. Does it guarantee payment based on the prevailing labor rates in your area, or only the discounted rates they've negotiated with their network? This single detail can mean the difference between a high-quality repair from your trusted mechanic and a constant battle with your insurance company. Finally, the fifth and most overlooked red flag: the cancellation and non-renewal clauses. You need to know on what grounds they can dump you. Non-payment of your premium is obvious, but what else is in there? Most policies will list specific triggers for a midterm cancellation, such as fraud, a suspended driver's license, or a major conviction like a DUI. The more interesting part is the non-renewal section. This is their right not to offer you a new policy when your current one expires. The reasons for non-renewal can be surprisingly broad. Sometimes it's having too many claims in a short period, even if they were all not-at-fault claims. To the insurer, you might just seem like you have bad luck, making you a higher risk. In some states, even a significant drop in your credit score can be grounds for non-renewal. Reading this section manages your future expectations. It reminds you that your relationship with your insurer is purely transactional. You are a number on a risk assessment spreadsheet, and knowing the rules they play by is your only defense. So there you have it, the final check. the deep dive into the legal jargon that separates the amateurs from the pros. It's the least exciting part of the process, but it is, without question, the most important. You started this journey just looking for a better price on car insurance. But you've learned so much more. You've learned how to assess your true needs, how to decode coverage types, how to leverage discounts, how to negotiate from a position of power, and now how to dissect the very contract that binds you. You are no longer just buying a product. You are making a strategic financial decision. You are protecting your family, your assets, and your peace of mind. The power is now in your hands. This knowledge makes you more informed than 99% of the drivers on the road. Don't just use it to save a few $100s. Use it to buy the right protection, the kind that will actually be there for you when the worst happens. Take this guide, rewatch the parts you need, and share it with the people you care about, your friends, your family, your kids who are just starting to drive. Because a better informed driver is a better protected driver. You've done the work. You're ready. Now you know how to shop for car insurance like a pro.